the first webinar we're going to hold, and we thought it'd be appropriate we start by telling you about the 3 best investment strategies we've tested. I'm sure you've read about some of them on the website, but I thought it'll be good if we can just go through it and maybe discuss some of the finer details of them, and just to give you an overview of what 3 strategies we really think are ones you should seriously consider using in your portfolio. So let me go to the page. Next page is the agenda. As I said, we're going to tell you about the strategies, what they are, what their performance has been. This is, of course, very important because you want to know the performance before you think about using a strategy, and how you can use them to get ideas. I'll show you a few screenshots in the screener to show you exactly how to implement them. And then afterwards, I will answer any questions you may have. So if during the presentation you have any questions, just type it into the chat box. And as soon as we're done, I will address some of these questions. Okay, the first strategy I'm sure you've seen. It's 6 months momentum combined with a low price to book ratio. So this means you would first select the 20% of companies with the best 6 months share price momentum. That means companies that have gone up the most in their share price in the last 6 months. And then from this list of companies that you've gotten, you select those with the lowest price to book ratio. You will see in the screener we use the book to market ratio rather than the price to book ratio. The simple reason is that if you use price to book, you want to search for companies with a low price to book. So if there are any companies with a negative book value because of write-offs or huge losses, then those companies will rank the highest according to the price to book. If you use the inverse of the price to book ratio, the book to market ratio, you will search for companies with a high book to market ratio, and these negative book value companies will automatically fall off the list because they'll be the worst rated companies. Does it work? Now, this table is put together of other investment strategies we've tested if we've already selected the 20% of companies with the best 6 months share price momentum, which means we tested 6 months share price momentum, the best 6 months share price momentum, against these 13 or 14 other strategies. And as you can see where the arrow is pointing, price to book did extremely well, 1,157%, compared to the next best strategy, which was earnings yield, at 1,000%. And this was over this 12-year period from June 1999 until June 2011. How do you look for ideas? Is using the strategy in the screener. Very simply, first of all, you select share price index 6 months. This is for the momentum companies. Select 20% on the slider to get the companies with the best momentum, and then use book to market with the 20% of companies with the best book to market ratio. This screenshot at the bottom is that of the output of the screener, and there you would select book to market as one of the ratios you want to show, and then click on the heading to sort it by book to market from high to low. Remember, you're using book to market, so you don't want to sort from low to high. And once you get that, then you'll get a list of companies that will that exactly fits the strategy. But be careful of the price to book ratio. I don't know if you've read the article. You'll see when I sent you the presentation, you can just click on this link and you can read a more detailed article about the price to book ratio. It underperforms the market for long periods of time. But let's first get to the important point. Price to book does extremely well after a large correction. And if you look at the test period of that previous screen, you'll see it was from June 1999 till June 2011. That means the internet bubble that burst was included in that test period, as well as the financial crisis, or a large part of the financial crisis. And that's why that strategy did extremely well. But it also underperforms for a long period of time. I don't want to get into a too long discussion here now, but there was a lot of testing that James O'Shaughnessy did, and which I cover in that article. So be careful of the price to book ratio. Here are a few ideas that currently meet the strategy, and as you can see, inevitably with a low price to book strategy, you find a few odd companies. I've screened for a lot of large cap companies here. I didn't want to include a lot of small ones. As you can see, a few interesting car companies there, and others that have also, mining companies that have maybe been doing well. Fiat is there, which is surprising. And let's move on to the next strategy. Neglected value momentum. Now, this is a strategy that selects companies that are neglected by the market, that are undervalued, and have good share price momentum. How do you screen for investment ideas with this strategy? First, you look for companies with good 6 month share price momentum, exactly the same as the previous strategy. And then to find neglected companies, there's a ratio that we tested that worked extremely well. And it's a ratio that finds neglected companies by screening for profitability divided by traded value over a year. This means if a company trades a lot, this value will be low and it'll not be seen as a neglected company. So in other words, you're looking for companies with good amount of profits compared to low liquidity or not as well traded as the others. Those are neglected companies because brokers can't make any money recommending these companies, trading them. That's why there's a reason for, or a better reason for these companies to be mispriced. And then we screen out low quality businesses, and we do that by using the gross margin ratio as developed by Professor Novi Marks. This was also a very interesting ratio. You can read the whole article by clicking on that link in the presentation that you can see. But it basically takes gross profits over total assets. And that is one of the best quality ratios that we've ever tested. Return on invested capital doesn't work nearly as well as this ratio. And then once you've narrowed all the companies down to a list that meets all these criteria, then you look for the companies that are most undervalued by earnings yield, EBIT to enterprise value. And then you buy the 20% of companies that are, with the highest earnings yield. Does it work? The strategy worked really well. As you can see, the test period from June 2001 to August 2014, rebalanced every 6 months. The index we compared it to was the European Stock 600 index. We tested it over the European stock universe. Number of positions, as I already said, you buy the 20 companies. Rebalancing, we included a small rebalancing cost. What was the total return? 1,374%, which is extremely well. If you take it, that worked extremely well if you compare it to the market, which returned only 57% over the same period. Drawdown was largely similar, about 5% less. But as you said, the strategy really performed very well. How do you screen for companies with a strategy? It's also very easy. There's more indicators, but quite easy to set up. First of all, you select companies with the best price index. Then low liquidity, traded liquidity, 0 to 30% I set up here. And then you use the quality factor, the Novi Marks gross margin ratio, screen for only the companies with the highest ratio. And then in the export or the results part of the screener, you select earnings yield, click on the heading to sort them from high to low. Remember, with earnings yield, you want companies with a high earnings yield. That means a high EBIT to enterprise value ratio. What are the current investment ideas? Again, I only looked at large cap companies, and there are quite a few interesting names there, quite a few mining companies. Here's a travel company. An interesting one is Novo Nordisk, which is on here. The earnings yield is not that high, but that's the biggest insulin manufacturer worldwide. Now getting on to the third strategy, and this is one I think you may have guessed. Long-time readers of my emails may have guessed is one that I want to bring up. It's QI value. QI value is basically a ranking system that we've developed based on all the best ratios and indicators we have tested. We rank all the more than 22,000 companies in the screener by this QI value. And the QI value is made up of 4 individual ratios that we rank by. First one is a profitability ratio, EBITDA yield, earnings before interest, taxes, depreciation, and amortization divided by enterprise value. Second one is also a profitability ratio. This is earnings yield that you saw from the previous ratio. It's EBIT divided by enterprise value. The third one is a is a cash flow evaluation ratio, free cash flow, which is calculated from the cash flow statement as cash from operations minus capital investment divided by enterprise value. And the fourth ratio is the one I explained already, is liquidity QI. It helps you to identify companies that may be mispriced by the market because they're not as highly traded. Why so many ratios, you would be thinking? Well, it's to find companies that are undervalued from different points of view, because as you saw rather, we use two different profitability measures from the income statement. We use the cash flow statement and we use the traded liquidity. And this gives you a nicely balanced valuation ratio that looks at the company from different points of view. So there's a lower chance that if any one ratio underperforms in a certain market period, that your strategy will underperform because you're using so many valuation ratios to identify undervalued companies. And does it work? We tested it first over 14 years, and then we updated the test recently so that we have backtest data going back over 16 years from April 2001 up till June 2017. If you look at the first line of the table, you'll see that's the 14-year period that we tested the QI value. Gave a really nice return of 477%. It compares very, very favorably with the market, but also with other investment strategies, as you can see here. The 2016 return wasn't quite as good as price to book, but still a very, very stable return. And that's the other thing about this ratio. Because it uses a lot of ratios, it may not be the best performing strategy if that one ratio performs very well. But because there's a lot of ratios, it'll always have a really consistent performance. And that you can see here throughout the table. In 2017, it did really well, 13.1%, slightly better than earnings yield and also price to book, but a lot better than the market. Total return, as you can see, has been substantially better than the other two ratios and the market, with a nice annual compound annual growth rate of 13.8%. How do you find values, investment ideas with QI value? Well, it's very simple because all the ratios are already built into this QI value indicator. That's the only one you really have to select. And then you select 0 to 20% to get the best companies rated by QI value. Make sure that you select QI value as one of the export columns of your screener, and then sort these values from low to high. This is important. The lowest QI value is the company with the best rating. So you want to look at the lowest QI value rating companies first. And what are some of the values or companies that currently meet the criteria? Few auto companies here. Remember I told you about Fiat there. Peugeot is also there, and then a few insurers as well, including Deutsche Telekom at the bottom here, which has always been quite a good dividend payer. Anyway, so just a note or a quick thought about backtests in general. Remember, as a good friend of mine always reminds me, you cannot calculate yourself rich in the past. These strategies and backtests that we do is only to make sure that these strategies also work in Europe compared to the USA. As you know, there's lots of testing going on in the US market, but not so much in Europe. So we just want to make sure that these strategies also work in Europe. And no investment strategy will always work the best. So if you think about the price to book and 6 months momentum strategy, that strategy had a substantial outperformance up until that end of that test period, but it may not be the best strategy going forward. But because it works over long periods of time, if you stick to the strategy, you will most likely get really, really good returns. And that brings me to the following point. If you follow a strategy that has worked in multiple markets and one that lets you sleep comfortable at night, and that's very important, because if you're not really comfortable with an investment strategy, you probably won't stick to it. And the reason is you won't stick to it is because you don't believe in it that strongly, which means that if it does underperform or does really well, really badly when the market collapses, then there's a high probability that you'll sell out right at the bottom. And that's probably the worst thing you can do with any investment strategy. But if you can follow these two guidelines, find a strategy that you like, that lets you sleep well at night, you will very likely have very, very good returns in the long run. And now I'll take some questions if there are any. I see so far nobody's posted any questions, but if somebody's got a question, I'll hang on a little bit and see if there's anything I can help you with. I see there's a question from one of the participants. He asked, how often is the data on the screener updated? The screener on the screener is updated every day. In other words, at about 9 o'clock or 10 o'clock European time, the closing prices of the previous day will be updated in the screener, as well as any fundamental data that we've received from our data supplier. And that happens on quite often, quite shortly after the results have been published. Here's another question from a participant. He asked, how many companies should we buy? I'm a big proponent of saying, keep your position small, but apply the strategy on a monthly or a quarterly basis. That means every quarterly or monthly basis, look at the screener, because the companies change quite substantially if you use momentum as well, because there's a lot of price movements, and then buy a few companies each month, that you feel comfortable with. And small positions, I mean about 2% per investment. That means it'll give you about 50 companies, nice diversification, but not too greatly focused in any one company. That if something goes wrong, it can really leave a big hole in your portfolio. There's a very good question. The screener uses trailing 12 months data for all the ratios that are calculated if it's available. This means that so you don't have to wait for the end of the year to get a data point or a ratio that evaluates the company. As soon as the quarterly results are in, then we use the trailing 12 months to give you the ratios and the indicators, so you find companies based on updated recent data all the time. How long should we hold the companies in the portfolio is another question that somebody asked. I used to hold the companies for 1 year. If the company doesn't screen well, after a year, then I replace it by some company that screens well or that is more highly rated in a strategy. But what I've done recently is I've simply just put a trailing stop loss on the companies that I follow on a daily basis, but I only look at it really on a monthly basis, similar to the newsletter, which means when I buy a company, I keep on moving the stop loss up if the company hits new highs, and as soon as it loses 20% from the highest point that its share price reached, then I sell it. This means, the reason I did this is because I saw that companies ran up quite substantially after I sold them, which means if I use the trailing stop loss now, then I'm not worried about looking at them again or whatever. They run up, and as soon as they start falling, then I sell them out and I replace them by companies that meet the point or meet my criteria in the screens that I use. Quite a few questions came in now. Let me see. There's one question that I don't quite understand. Maybe you can just clarify the question. The person that asked the question about the 200-day average filter. I'm not sure what you mean with that, but if you mean the 200-day simple moving average, there's an article that I'm in the process of writing about applying a simple moving average to an investment strategy. And it basically says if any index is below its 200-day simple moving average, then just don't buy anything in that market. Say, for example, the US market, the S&P 500. Because when the markets are below the 200-day moving average, it means that they are moving down. And specifically, if you use a trailing stop loss strategy, what that may lead to is you keep on buying companies because it meets your strategy. But because the markets are falling overall, you would be stopped out of those companies in in a month or two if the markets just keep on falling. So only buy companies if the index is higher than the 200-day simple moving average. Let me see what other questions there are. One of the attendees asked that it's confusing because he doesn't know which values should be low. For example, low values are best or high values are best. If you look at the screener, you can see that the 0 to 20% will always, I say always because there are a few small exceptions, but if you want to implement the strategy, just go to the footer part of the website. If you go right to the bottom of the website, you'll see there's a small link. It says glossary. And if you click on the glossary and go to any one of the ratios that you want to use in the screener, it'll tell you exactly how the ratio is calculated and how to use it in the screener. For example, earnings yield, you want to set it from 0 to 20%, and then you want to look for the companies with the highest earnings yield. That's always explained there. And if anything is unclear, just click on the contact page and send me a question. I'll be very happy to clarify any questions you may have. Here's another question from an attendee that asked if we've updated some of the strategies that we tested in our book that we make available to subscribers. What worked on European markets? We haven't updated them for the simple reason that is we changed our database after we wrote that paper, which makes it very, very, very difficult to recreate, or a lot of work to recreate those strategies. And basically what we tried to do with that book, as I mentioned before, is we tried to duplicate a lot of the studies that were done in the USA to make sure that they also work in Europe. And once we were sure that that's the case, then we just simply use the strategies. And from then on, as you can see with some of the later papers on our blog post, we keep on using the best ideas that we got from the paper and build on them, which means that a lot of the stuff that we are suggesting now and we're testing further builds on the work from those strategies, and that's why we haven't updated them. Here's another question where a participant asks if we rebalance every 6 months or every year. We have done some testing on rebalancing, and we found that 6 months rebalancing worked best, but it was marginal, which means, or the benefit that you would have gotten was marginal. And because this difference was so small, you must be very, very careful of trading costs. If you can if you can get a broker that really charges very low trading costs, that'll be an advantage. And I think then you can make use of 6 months rebalancing. Also, if you're very focused on using a momentum strategy, then 6 months rebalancing, or if your trading costs are really low, I think you can even go to 3 months rebalancing. Just to get back to that question on the 200-day moving average, a participant asked if you just go to cash in that period. Yes, you just go to cash, or you don't buy any companies. And with me, if the 200-day moving average is below if the market is below the 200-day moving average, I stop buying. And then, of course, if the market falls further, because I use a trailing stop loss, then I will be slowly stopped out of all the other positions in my portfolio, which means if the market really goes down substantially, I'll probably be stopped out of all my positions. And because the market is below the 200-day simple moving average, no other companies will be bought for the strategy that you follow. He also asked if I have a research paper. I'm going to write a paper or a blog post where I'm going to refer to a research paper. That'll be the easiest way. It should come out within the next 2 or 3 weeks. Hammond, I'm not sure about your question. You ask if it works for the selection screen, but not on the results screen. Can you just maybe write a little detail, or just clarify the question a little bit? Then there was a question from Nadia. Nadia, yeah, these strategies should work fine in the US market. They've been tested substantially there, so I'm sure you'll be able to find some backtest information about them. The neglected value momentum strategy was the only one which we only tested in Europe. The others were all tested, let me just think. No, the price to book and momentum was also Europe. But QI value, that was a worldwide test on all companies worldwide that are included in the screener. Chris asked, would I recommend if we only use the strategy on Swiss stocks, only 200 Swiss stocks on the Swiss exchange? Chris, I would not recommend that. Cast your net as wide as possible, because then you have the biggest chance of finding companies that are really undervalued. I mean, if you look at only 200 companies, you'll find companies that you know, in this 200 which will be better or worse according to a certain strategy. But if you can cast your net as wide as possible, that'll be far, far better, because you just find so much more really undervalued companies compared to the Swiss market. Samir asked if we've ever tested companies based on short interest. No, we haven't. Samir, and the reason for that is the short interest data is only available for US companies. You will see if you start looking at European companies, our data supplier hasn't got that information. I don't think across all the European markets that information is really well added together, so you can get some kind of idea of what the shorted value is. Just remember, we have a spreadsheet for subscribers that are updated on a weekly basis, where you can see the performance of all these strategies on a year-to-date basis. Just go to the dashboard section of the screener after you've logged in, and there's a file called What Works on the Street, and it basically shows you the performance of all these strategies. I think there's 13 or 14 strategies we track on a continuous basis. Also look for the 2 blog posts I wrote about the best strategy in 2016, which is basically this this paper, this summary of this spreadsheet, and also the first half of 2017. At the end of the year, as soon as we've got those results, probably in January or February, I'll write a paper on what was the best performing strategies of 2017, so you can look out for that. Francesco asked if I work with CFDs or other derivatives. No, I don't, Francesco. I just use, I buy the companies wherever they are, and I always try to buy them. For example, there's a lot of companies that trade in Germany in the form of ADRs, but I always try to buy the companies in their home country where they trade. It's just that the volume is a lot higher and the bid-ask spreads are not as wide, so it's, you know, your transaction costs are substantially lower. And I found that if something goes wrong and the market starts falling and you want to sell, then if you've bought shares, say for example a Japanese company on the Frankfurt Stock Exchange because some broker is offering it, the spreads are just as completely wide because the broker is worried about losing money, and you just can't get rid of those shares, because generally I think your broker says you have to sell it in the market where you bought it, otherwise there's the transaction cost for them transferring the shares to the home market. Chris asked, where do we get the data from the screener? The data from the screener comes from one of the big data suppliers. We can't give you the name, unfortunately, due to contractual reasons, but I use the screener for my own money. That's basically how the screener got started. So I have a very, very big incentive to make sure that the data is correct and up to date, because I put my own hard-earned money to work using the screener. It's updated on a daily basis. As I said, 22,000 companies. Financial statements get updated a week or so. You know, if there's a December rush where everybody's published their financial results, it takes a bit longer. But results are updated quickly. The the data is extremely good quality. We've had a few users compare the data to Yahoo Finance, and we get these questions about why is the number different to Yahoo Finance, and in 99% of the cases it was because our data was updated more quickly. So if we look at the trailing 12-month data, ours is more up-to-date, and that's why there was a difference between the calculation of our ratios and, for example, Yahoo Finance. Okay, Herman just referred to the QI value indicator, where I said it must be sorted from low to high, and he asked that I just make it clear. I'll look at the glossary, Herman, and I'll correct that to make it as simple as possible. Also, I have a question. We developed a new screener, or we're in the processing of developing a new screener, and we've basically finished with it, but we want one or two users. Some of you have already tested it, but if you would like to play around with it and give us some feedback on where we can improve it, please just write it in the questions and answers, and I'll send you a link, and I'll sign you up to be a beta tester, and you can and we'll be very happy if you can give us some feedback on the new screener. It's a sort of a professional version of the screener, which is mainly based on a spreadsheet model, which means there's probably more of a, you have to learn a little bit more and maybe a little bit more patient, but you can do so much more with it. You can basically export the results to an Excel type sheets where you can calculate your own ratios, sort by the ratios you want to. You can do averages. You can really watch your portfolio on a daily basis because it's all spreadsheet based. If you're interested, just write me a little note on the question and answer box, and I'll send you an email. Nadia, dual momentum, I wrote a blog post on it. I'll send you an email on how you can best apply them with the strategies. It'll be a bit cumbersome to explain it now, but I'll send you an email. Thanks, Rob and Nadia, for putting your names up for the beta testing. I will get the email out to you. And that's it, everybody. It looks like that was the end of the questions, and we've gone over the time a little bit, but I was happy for all the questions, and I hope it was helpful. Thank you very much for attending, and look out, because it was a lot of fun doing the webinar, and I'm sure we'll find a few interesting topics that we can do some webinars on in future. Thank you very much, and thanks for attending.